Hi, this is Keith Schneider, CEO of MarketCage.com, and this is March 4th, 2018 edition of Market Outlook. All right, so what we're drilling right down here into the four key US indices, and let's see what that's telling us. Well, for one, you can see that we've closed under the 50-day moving average in three of the four key indices. So that's definitely a downgrade from last week. Now remember, we also mentioned that in terms of real motion, which looks at momentum, we've also correspondingly weakened, and we're trading on the sort of the lower end of what the meat of the action has been going back months and months. So momentum definitely looking iffy. The price action, three out of the four indices in warning phases. Now, what is interesting is on Friday, IWM, the Russell 2000, put in really strong relative performance, especially compared to what was leading, such as in the Dow. So there's an interesting shift here, and that could be related to the tariffs on steel. So, in essence, uh, companies that depend a lot more on foreign trade, multinationals, big cap stocks like the Dow stocks and the S&P definitely can get hit harder if there's a trade war than companies like the IWM, which is the Russell 2000, and they are mostly domestic U.S. companies where the majority of their business is done domestically as well. Now, the one holdout and exception is the Nasdaq 100. That's held nicely off of its 50-day moving average, sort of sitting right in the meat of the overall action in terms of its pure momentum. Now, of course, last week we noted another potential yellow flag here is even though we sort of matched price-wise the highs from mid-January to late January, momentum definitely on a divergence. So now the markets really have to decide. In terms of important and critical levels, right? One thing we want to do is make sure that on a weekly basis we don't close under 268.50. On the Russell, key thing, it held the 148 level, and what we really want to see it is get through 152 and stay above there. Now it closed there on a closing basis, so that's a really positive sign here. So good news on that. Holding the 200 DMA, which is basically around the 146 level. So you definitely want to see IWM hold that 200-day moving average. But meanwhile, what is promising is this move up in IWM. And if we can clear the 50-day moving average, that would be excellent as well. Okay, so let's take a quick look at the weekly charts, just see what that's telling us. And really, the key thing on the weekly charts is the momentum, especially in the strongest indices, are holding up quite well. So, for instance, right here, you can see we're above the 10-week moving average, well above the 50. Trend is clearly intact. In terms of momentum, yeah, we backed off a little bit from the highs, but it's still strong on an absolute basis. You can sort of say the same thing with IWM. Not quite as robust as the Nasdaq 100, but still very, very strong. And again, the strongest, and it's important to see which way this thing breaks now, is the Dow. Although it came off hard this week and lost strength relative to IWM, it's still holding nicely above its rising 50 and 200 week real motion indicators. And again, the SPY, sort of the most iffy at the moment because it's sitting right at a key inflection point here. If we break down much more from here, it would certainly bring in a test at 253 on the weekly charts, and that's 13 points from the close here. Excuse me, 16 points. So that's a fairly substantial move. It's a good 6 to 7% move down from here. So the net takeaway from looking at the price movement is that the S&P, excuse me, the key indices, 3 out of 4 on a daily basis on the charts, looking more negative, right? And on a weekly basis, the longer term trends still intact. All right, now let's take a look at some key market interrelationships here. And we'll just scroll up. So the key one is the S&P versus utilities. So right now it's as you can see here, it's basically trading at or a little bit above the monthly moving average of the spread. That's a positive sign. It means the S&P still outperforming the utilities, both on a monthly basis and on a longer term basis as well. But as you can see, we were sort of straddling back and forth this week, but because of the close on Friday, we closed in a strong position. So the next thing to look at is the other 4 key intermarket relationships. And as you can see, they're all hovering around that key monthly indicator here, right? So against bonds, we're basically still favoring the S&P. That's a positive sign. Now it's sort of straddling it, so it's going to be interesting to see the way that breaks. In terms of high yield debt, interesting. It started breaking down this week, and so that is a bit negative. Now, the other point to make is that the S&P still outperforming gold, but we're at a critical inflection point. This is really important looking at the S&P versus gold, because this is a good lead indicator of inflation and just what the central bank's power remains. So that is really important to note. At the moment, S&P sitting right at key inflection points for both the monthly and the 6-month. It's still favoring the S&P over gold, but much more weakness from here could be an important point telling you that gold is on the move and the S&P potentially under a lot more pressure. So we want to definitely watch how this ratio plays out. We got a positive situation still with wood outperforming gold. So if you're going to get inflation, it's much better to have it without fear. So when wood is outperforming gold, that's a positive overall scenario. So again, the key things is that the intermarket relationships are still in a positive framework here, although potentially close to shifting. So I would suggest coming back to the website and making sure you stay on top of what's happening here. Now, in terms of volume, one thing that is certainly clear as well is that institutional volume still favoring the short side of the market. That's also adding pressure here. So as you can see, right, especially with the Nasdaq, which is interesting because it's still pretty strong. 5 distribution days, 1 accumulation day. If you tally up all the distribution, it is doubling at least the accumulation days. So market definitely under pressure. All right, let's take a look at what sectors are leading and if that gives us any more insight as well. What is a positive sign is that the semiconductors, right, which had been looking the most iffy, actually held up well. Over the last 5 days, you can see Nasdaq, excuse me, the S&P down 2%. However, semiconductors held up well, right? And that's positive because this is definitely the leading sector on the board and still leading. Now, the other point to note is that utilities, because of the pressure on bonds, also got hit. So it's not giving you all that much help in determining risk on, risk off. Weak utilities in the face of weak bonds is expected. So not really a great read there. However, the other thing to note is, look, the most conservative play down 1% for the week, 1.1. It's one of the best performing sectors in the market. And consumer staples are definitely a move to a safer, more defined play in terms of yield, right? Because generally those consumer staple stocks pay a decent dividend. So what's interesting, two things. A conservative play led the market by going down the least, and of course the leading sector still putting upward pressure on the market. So I would say mixed overall message. Of course, you can see from the movement overall, most of the sectors were down. Now, in terms of looking at the overall momentum, not much really changed for the week. And again, we have a lot more sectors showing good strength. So on a longer term basis, we're in good shape. And again, this is consistent with what we saw in the other pieces that we just ran through. So taking a look at market hotspots, just looking at things around the world and a global basis, there are a couple things that also reinforce what we just reviewed, right? Of course, you can see that bonds, right here, they were sort of neutral, excuse me, on the week, but right, 0.9%. So not surprising when the markets definitely get under pressure. Flight to safety on the TLTs, but not much. I mean, considering the market's down 2% for the week, and these were bonds were only up 0.19%. Not a huge amount of panic and putting upward pressure on U.S. Treasuries. So what that's telling you is lots of pressure on the market, and it's mostly coming from the fact that bonds are definitely still under pressure. And remember, looking at it on a 3-month basis or even a 6-month basis, they're both down sharply, and that could be a persistent trend, especially with everyone looking at the fact that the longer term rates may have finished a 30-year down cycle, and that is not good for the markets. The other thing to note is volatility was very strong this week. Not surprising, but volatility definitely showing some signs of renewed pressure on the markets as well. Now, in terms of the whole concept of inflation, commodities, putting pressure on bonds, and in fact, the Fed potentially being out of control, take a look at this. Corn, right, up 2.36% for the week. So there's definite some attraction in commodities that we need to pay attention to. And this is definitely a bellwether sign that commodities are definitely catching a bid here. And considering they're still basically damn close to 100-year lows relative to the price of stocks, this is something to keep track of, and something we're going to get into in a little bit more detail a little bit later in the premium section. So those are the key features to watch out for, and basically the overall scenario, the summary here is watch commodities, the stock market on a shorter term basis definitely looking iffy, although it appears that the longer term trends are still intact. And so we're going to have to see just how this short term plays out. All right, that's it for now. We're going to move on to the premium section.